Good morning and welcome to NWF's results presentation. This is for the half year ended 30th of November 2015. Very pleased with the set of results because in spite of some very difficult market conditions, we've achieved a result which is slightly higher than last year. So that's a good result. It's actually the second highest profit that the group's achieved in its first half. We'll look at some of the details in the results. We've delivered on our stated strategic objectives, and that's in spite of some pretty tough conditions out there. Conditions that we're used to and used to responding to, but if I just highlight some of them, we've had a low milk price, so milk at a record low, and that's continuing. We've also had a fall in commodity market, which again we've seen before, but I don't think any of us could have anticipated the fall in oil prices we've seen in the first half this year. But remember, that fall in oil price does not negatively impact our business performance. And we've also seen a warm autumn, which has meant a later turn-in of the dairy herd and also less demand for heating oil in the first part of our year. If I look at the activity levels in all three divisions, they're positive. They're all up. They're all ahead of prior year. In feeds, we've increased volumes. In food, we've increased capacity, and actually we've utilised overflow capacity in the northwest of England. And in fuels, we've also grown volume in the first half year. Positively, we completed some good acquisitions. That was New Breed in July and Staffordshire Fuels in November. And both of those acquisitions are performing well. And very positively, we're able to reduce the net debt of the group, and that's in spite of making those two acquisitions in the half year. And as our normal policy, we've maintained the interim dividend at a penny. So if we now look at some of the numbers behind the results, you can first of all see the group revenue, £225 million in the first half year, and that was down 9%. And as you'll know, revenue is not a key indicator for the group. It very much more reflects the lower revenue that we get from oil because the oil price has fallen and the lower prices in feeds because the commodities have fallen. It's not a negative impact on the group. The key number for us is the operating profit and the PBT. So operating profit, you can see 2.8 million in line with prior year. And then headline profit before tax, probably the key number that we talk about, 2.6 million, 4% up on prior year. And in point of fact, it's actually the second highest the group's achieved. What that translated into is an earnings per share up 7.5% to 4.3 pence. And then when we look at debt, down 16% to 10.4 million. I said that's in spite of making two acquisitions, having spent just under £5 million. So it shows the really good cash flow and working capital management that we have at NWF. And in fact, that's 0.8 times EBITDA. So that's a very safe, comfortable level of borrowing, and the dividend maintained at a penny as it was last year. I'll now really turn to each of the three divisions, just take you through the operating highlights. So first of all, if we look at feeds, this is clearly operating in the dairy market. You see one of our clients there at Willow Grove Farm in Cheshire. That's Simon Crank, one of our key farmers. He actually has over 400 dairy cows in his herd. And he's experienced difficult conditions with the low milk price. The average milk price in the UK is now 24 pence, which is below the average cost of production, and no sign of any changes to that in the near term. Commodities in the market have fallen. If I take a basket of feed products, they'd be about 8% lower than they were prior year. And there've also been a fall in the market because of the warm autumn. So DEFRA's data for our first half year shows market volumes down 3%. So I'll now turn to our business, and we've actually done well in that difficult market. You can see, first of all, our volumes are up over 2%, and that's against a market that's fell by 3%. We've also delivered good operating efficiencies, and that's both in terms of our mills, in terms of how we're utilising our presses and our equipment, but also how we're being efficient in delivering across the country with our transport network. So you can see the operating profits increased from 0.1 million in the first half last year to 0.3 million in the first half this year. Now, we do have an acquisition to support those figures, and roughly half the improvement in profitability has come from the New Breed acquisition and half from the underlying business. And you can see there the volume, bottom right, up just over 2%. Then move on to food, and this is the Bowie business. Good demand levels in the summer. What we're trying to do here is keep the warehouses full and fully utilised all the way through the year. Now, we're pretty full today. And what that meant was we were overfull during the summer months. And we actually utilised some overflow storage in Crewe and also in Wrexham. Now, while that gives us additional revenue and additional business, it's not profitable because we have to haul at our costs the product from Wardle to Crewe and then back again. So whilst it gives us utilisation of storage, it does have some negative impact on efficiency. Positively though, we maintain service levels at 99.7%, which our customers demand. We've also been very good at looking at optimising when products are available for dispatch, so we've been preparing loads well in advance. What that's given us is the ability to leave on time, so we're therefore very attractive for subcontractors. It's also given us the ability to increase the revenue and profitability of some of the backloads. Because we know we're leaving on time, we can therefore schedule those loads to be picked up elsewhere in the country. We also had a very strong performance from our repackaging operation. So in Halloween, as an example, we did 15 loads a day for 10 days. That's nearly 4,000 pallets of products specifically designed by our customers for Halloween. And we also mentioned last time our new pallet line operation, where we're distributing individual pallets around Cheshire. It's a small operation, but it started in line with our plans. So you can see operating profit 1.4 million, a tad down on last year, but that's really just as a result of being overfull during the summer months. And you can see our average pallets stored up to 99,000, and really our operating capacity is about 95,000. So good levels of activity. Then thirdly, on fuels, a few factors here. First of all, the picture there is of the fleet of Staffordshire Fuels. So Staffordshire Fuels we acquired in November, performing well so far in the year. And you can see their fleet of yellow trucks. They're a Phillips customer and therefore jet branded as Staffordshire Fuels. A very well invested fleet. Now let's have a look at the oil market. So some dramatic changes here. The average price of Brent crude has fallen 47% in the first half this year to the first half last year. So a very dramatic reduction. And that doesn't have a negative impact on NWF because all we're doing is buying on the spot market and then selling it on to our customers across the country. It has improved affordability, and if you're actually on oil as a heating source, it's now 30% lower than natural gas. So it's a really cost-effective way of heating your home or using for cooking. But interestingly, our average order size is the same as it was a year ago. So people are just benefiting from the lower price. They're not buying more in advance of any price increases. We're also talking about our two new startups at Martlet Fuels down in West Sussex and also Home County Fuels down around the Thames. Both small businesses, but we're looking to invest in these new startups to really generate and build depots over time. We've also driven volume growth. You can see the total volume, 213 million litres. That's up 8% on the year. And that volume growth has come from diesel sales into the commercial segment and also a 33% increase in the sales of our card marketing operation. So good growth there. The warm autumn, conversely, has reduced demand for heating oil, as you'd expect. And Staffordshire Fuels, as I highlighted earlier, performing well and continuing to perform its first couple of months of operation. So you can see operating profits there, 1.1 million, and volume up 8%. I'd now like to carry on and look at some of the growth opportunities for NWF over the coming months and years. And first of all, let's look at the development strategy. What we believe we have at NWF is a very solid platform for development. First of all, we've got a diversified source of earnings. We've got 3 divisions operating in 3 markets. What that means is we can have outperformance and underperformance, but the net result is good, steady progress, which is what we've seen over the last few years. Our businesses have proven their ability to generate cash, again in this first half, so we've got a solid cash generative business. We've also got big, stable markets. This is about ambient groceries, the market's big and stable. It's about fuel, the amount of fuel we use is really consistent, and the market for dairy feed and ruminant feed is very stable year on year. In terms of development focus, we're looking at agriculture. We believe there are consolidation opportunities here in the UK. We also think there are opportunities with some more innovative business to target our existing customers. In fuels, we can develop through new startups and also through bolt-on acquisitions. And in food, we can really develop with our customers as we look to match our customers' needs and potentially take on additional space and warehousing, or indeed look for new customers to come and utilise our network. And in terms of an overall, it's very much looking at a focus on total shareholder return. We recognise as a small cap stock, dividend yield is not sufficient. It's necessary, but it's not everything you need. And therefore, you're looking for the share price to move forward and for a progressive dividend. So that's very much what we're looking to achieve at NWF. And I'll turn on to each of the 3 divisions in a little bit more detail. So first of all, in agriculture, some tough times at the moment in the short term, but in the long term, it's very positive. There's population growth, we're eating more, and therefore the outlook for farming and UK farming is positive. If you actually look at the chart on the top right of this slide, what you'll see is actually we're producing more milk year on year than we've done before. That's been true in the first half of this year and right the way through into December, where we're still producing 4% more milk than we did a year ago. Now that's part of one of the reasons there's downward pressure on milk price, and you can see the dairy herds also expanded to 1.9 million. The key thing you can see is that NWF, we're making progress against this big stable market. So you can see our market share has increased from 9 to 11 and then 12%. That's of the total ruminant market. If you just think dairy, we feed 1 in 6 dairy cows in Britain. So we're looking to expand in this area, and we do believe there are opportunities for consolidation. In fact, the tougher markets that we're seeing here today actually mean there are more people thinking as to whether they should remain in this market or potentially sell. So there are conversations that could be had today that perhaps couldn't have in the good market that existed a year or two ago. If I then move on to food, you can see there our Wardle site, which most of you know, a 50-acre site, and the positive news is that's broadly full. We're actually looking to add additional capacity in that site to meet our customers' needs, so we're putting in some new racking and warehousing which should increase capacity by a small amount, about 1,500 pallets in the next few months. So we're looking to be more efficient and more effective in this site whilst maintaining a very high service level. We're also looking to constantly innovate to meet our customers' needs, so whether it's repacking operations, whether it's our pallet line operation or other products and services that can enhance the customer experience. And in fuels, you can see the dots on the map are where the depots are. The yellow dot you can see is our new acquisition, Staffordshire Fuels. And what we're looking to do here is have depots which have a balanced business. So that's commercial and domestic customers, so heating oil, gas oil and diesel. So really get that balance so we're utilising our fleet of 100 trucks all the way through the year. The pictures down on the chart are actually our new tankers at both Martlet Fuels and Home County Fuels. And in the ideal world, we'll generate about 5 million litres of fuel out of each of these depots in the next 12 months, and they'll broadly be break even. So it's a tough way of starting to build a depot, but over time it can be very successful. The other way clearly is through bolt-on acquisitions, and that can be either within our existing territory or expanding our territory. Staffordshire Fuels is a good example of a bolt-on acquisition, and that fits in from Stoke really down to Birmingham, filling in that area where we have less coverage. So a good way of moving the business forward. So in terms of an investment opportunity, a number of reasons why we believe NWF is a very sensible one. We have a strong, experienced management team. Each of our divisions has lots of experienced staff in those divisions, which can help support and develop them. A lot of real detailed experience. We have growth opportunities, but we've also got very solid asset backing. As a group, we've got over £100 million worth of assets, and that gives us a security with which to develop the group. We're very focused on returns and cash management, as we should be. And actually what we're looking to do, as I said, is grow the business, but also move the dividend forward as well. So in conclusion and the outlook, it's a solid performance in the first half in spite of difficult markets. And always what we're looking to do is do what we say we'll do, but hopefully just do it a little bit faster and a little bit better. And I think that's what we've highlighted in this first half. There are targeted initiatives in each of the divisions, and we've also got the benefit of this diversified source of earnings. We're therefore not reliant on one market which may have tougher times. We've got a development strategy which is delivering growth, and the acquisitions that we've made in the first half are very much in line with the stated strategic objectives we've set out before. We've got significant financial headroom to develop the group going forward, but as always, we're prudently going to execute that. We're not going to borrow lots of money and go and do very scary things. We're going to be sensibly developing the group, very much as we have done over the last few years. And we're also reporting this morning that we're currently trading in line with the board's full year expectations. That concludes the presentation. Thank you very much.